Okay, so more and more people coming in, and we were just getting started on our today's sessions. And today we were going to talk about the two main strain of the option trading style. The one is using it as a tool to leverage the stock, which they will exercise it and they're preferring to hold the stock instead. And then the others is just trading the options as an individual stock to trade on, individual asset to trade on. They don't expect to exercise the options and they will just take the profit and losses from the option trading. And let me give a little bit introduction of my own to you all first, just in case if there's any new one coming in. Good evening, everyone. So my name is Hu Jun Law, and I'm a new teacher for USmart lessons, weekly lessons, and then I have 4 years of experience in fund management, 2 years specialized in quant trading, which I built my own algo board for managing the investor fund. And then you can call me Jay or you can call me 小何老师. It's all up to you. Even though I might seem young, but it's just the appearance. I do spend some years in this field. And yeah, I was just sharing all about my own personal story, my knowledge, my experience, and also everything related to finance and investment and trading to you all. So yeah, so still the same for every classes. We are not going to upsell you any courses, and I will not approach you to get any of your information and any of your money. So if there's someone else come to approach you for all those information and money, please be aware, it might not be me and someone that using my name. Okay, so the purpose of our lesson is just to sharing the knowledge and hope to improve together in this platform, and then we will just become a financial expert from a total beginner, and then hopefully we can make some money together. So let's start on today's topic on the option trading style. And today we are going to dive deep into two distinct approach to option trading that often create a debate among the traders. Our topic is option trading style, exercise versus the premium trading style. And I'm Jay, and in my years of trading and experience, in my years of trading and teaching, I've seen that how this different type of approach can significantly impact the trading outcome. And yeah, so before we begin, let me outline what we will cover for today. So this is the agenda for today. And first of all, we will just start by comparing these two major school of thought in the options trading. Then we will do a deep dive into each style. First is the exercise approach. Then we will follow by the premium trading approach. And we will analyze when each style works the best, and we will look at the practical implementations. What's the risk that we need to manage? And these sessions will run approximately 1 hour, and hope that we can just stay focused for a whole hours. And then I will mention up what will be the most important part that we cannot miss out. Okay, so I was sharing about the particular insight, my own trading personal experience also. So let's start on the first sections, the two school of thought. Now that we already outlined our journey today, and let's peel back the layers of option trading approach and understand the fundamental philosophy that drive different trading style. So in the option trading world, the traders typically align themselves with one of two philosophy approach, which is you can just look at the comparison. On the top, we have the exercise of focus trader. They're typically long-term directional traders who view the option primarily as a leverage stock positions. And they're essentially using the options as a mean to an end, that end being holding the stock or a short position at a favorable price. So they are using it as a tool for the final purpose of holding the stock at the favorable price. And then we have the bottom one, which is the premium focus trader. This trader will view the option as a trading instrument in themselves. They are more focused on the journey than the destinations. So they don't want to exercise it at the end. So to speak, they were just actively managing their position, focus on the time decay if they are doing the short positions, and if they are doing a long position, they will just quit before the expiration date. So they're typically just closing the position before the expiration, so just catching the price movement in the options premium, because the option premium move more volatile when you're comparing to the stock. So they're able to make more profit from the option when you're comparing to the stock. And for the first one, the exercise focus one, their end goal is to just hold the stock at the desirable price. So they're actually just using it as a tool to leverage, because one option equal to 100 share. So they can use a lot lesser cost to just achieve their end goal of buying or selling the stock at the desirable price. Okay, so this is the two type that we will be focusing on today. But in my experience, most of the people come to the option trading world with the purpose of the second one, because they want to make a very huge bag of return. They want to achieve like a few hundred percentage return, or maybe a few dozen percentage return. So typically they are just going to exit without exercising. So most of the people, I will say that 80% of the people will just go for the second one. Meanwhile, the first one will be some kind like Warren Buffett type, because Warren Buffett using the option just as a tool to get in at the desirable price. Meanwhile, he can just make some premium out of it. So yeah, even though there's no right or wrong in these two aspects, but you can see the aims and the goal are different, even though both of them make money also. But if you are going to the first one, there is high probability that you will be more likely to success in your trading journey, because it's a more safer way when you're comparing to the second one. Because most people go to the second one because they want to make big. So when you are aiming for a greater return, there must come along with a greater risk. So people might also losing a huge bag of money to the market if they are just purely trade the option as a trading instrument. Okay, so let's break down the key difference. Exercise focused trader are typically looking at the longer time frame. They are focusing on the intrinsic value, and they are very directional in their approach, because they are looking for a very long-term approach, and they might want to hold the stock for a very long time. So option is just a tools for them to get into the positions, and they want to exercise it because they want to hold this share for a longer period of time. If they don't exercise it, at the end they didn't hold the stock, and they might miss out the opportunity to just buy at the desirable price. So, and the premium focus one are usually working with a shorter time frame. They are focusing on the time decay, because if you are the short party, you are the seller party, usually you will just make the premium, and then you will just benefit from the time decay. And the other one, if you are a long party, you are a buyer, then you might just take the advantage of the greater movement. Okay, so this is the most important difference among these two approaches. Then we will just dive into the exercise focus one. And the exercise style trading actually just trade the stock as a mean to an end, that end being the stock ownership. Having introduced these two distinct approach, we will just go into the first one first. Okay, so this is the philosophy of the exercise style, or you can just call it the core principle of why they are doing this approach when they're comparing to the premium trading one. So first, there is a strong focus on the intrinsic value. These trader, or we can call it investor, are less concerned with the day-to-day fluctuation in the option premium. So even though the price fluctuated, the option premium fluctuated, it's not really important to them, because what important to them is the strike price. Because strike price is the desired price that they can get into the positions or they can get out of the position. So if they are just using it as a tool, the premium price doesn't matter a lot. What important the most is the strike price. Excuse me. Okay, so they're less concerned about the day-to-day fluctuations, and they are more focused on the underlying stock movement. And okay, the second core principle is they have a very directional conviction, because it's very crucial to them. When you are planning to exercise the option, you are essentially just making a leverage bet on the stock directions. So this is not about very small move. You are typically looking for a very significant directional shift that just justify the use of the leverage. And the third one, which is the long-term value capture. The long-term value capture aspect is particularly important. When you are taking an exercise approach, you are often looking for a longer date option, just like LIPS. LIPS is just an option with more than 1 year of expiration date. So they can provide an extended time for my thesis to play out. Because if I'm going to take the exercise approach, eventually I want to hold the stock. So I need time for my thesis to play out. I need time for that direction to run, So they're eventually looking for a longer time value capture, because they think that it might be difficult for the stock to just retrace back to the desirable price that they want to capture. Like for in these few months, the stock is rising really like crazy, So if they do exercise the option, a call options a few months ago, then they might capture some stock at a very low price when comparing to the current price. So if they just exercise it, they can hold the stock and enjoy the whole rally until now. But if they don't exercise it and they just take the advantage, take the profit out of the option premium difference, then they might miss out the further movement in this rally. And the last one is the capital commitment needed. When you are going to exercise the options, you will need more capital to do so, because you are actually going to buy in 100 share or you are going to sell out. So you might need to have enough money to buy in at that desirable price, or you might need the enough share to sell on the desirable price. So for example, if you are trading an Apple call with a 150 strike price, and you will need about $15,000 per contract if you intended to exercise, because 150 share price, so we times 100, and then because one contract is equal to 100 share, so you will eventually need 15,000 to just exercise the contract, to just buy in 100 share at 150. Okay, so that is the example. So this is the main core principle that support the exercise type trading. Then we'll just look into why this kind of exercise makes sense. What is the condition that can make this kind of trading type make sense and realistic? I will walk you through the very precise scenario where exercise become not just an option, but the optimal choice, but the best choice you will be able to make under that circumstances. So let's take a look at this specific scenario where exercise is the most optimal strategy. The first one is deep in the money scenario. When we are talking about in the money, which means that the strike price that you buy is currently way below the current market price. Like let's say let's say that you're buying an Apple with a strike price of 150. Then if Apple is now running at 250, which means that you are $100 away from the current market price. And that will be called a very deep in the money scenario. So a very deep in the money scenario might perhaps become the most common justification for this exercise. Let me show you why. Because if you're going to exercise it, then you are going to buy it at a very, very low price comparing to the current market price, which it might not be realistic for the price, the current market price, to retrace until the level that you want to buy in. So if you miss out this chance to just exercise and buy at a lower price, you might eventually don't have the chance again to buy at this desirable price. So you might need to just look for the others stock options, another chance in the future. So we just if this is really in a very deep in the money situations, and the price are unlikely to come back to pick you up, then it might be it might be the most suitable scenario for you to go with this approach. The second is the dividend capture. Let's look at the dividend capture opportunity. I will just give you an example. If a stock is paying a $1 dividend and your call options now only have a 30 cents time value remaining. So exercise it before the ex-dividend date could net you an additional 70 cents per share, because now the dividend going to pay you is way more than the time value remaining. So if you are just going to take just exit the positions, exit the trading option trading positions at the current situations, then you will just only making the time earning the time value of 30 cents. But if you exercise it and then you hold the share, if you hold the share, then you are entitled for the dividends. Then the dividend is paying way more when comparing to the time value. Then you'll be making more money. So we need to compare the dividends and also the remaining time value to just justify which one is the most suitable approach. If the dividend is bigger when you're comparing to the time value remaining, then exercise it and entitled for the dividend payout is way more better. Okay, the third one, the corporate actions. The corporate action will create another compelling cases for exercise, like during M&A, merger and acquisitions, or very specific dividend situations. Being a shareholder rather than being an options holder can be more advantage, It depends on the situations. And the last one is the tax considerations. When you exercise the options, you are actually converting the contract into an actual ownership of the underlying assets. And this transaction will trigger a very specific tax consideration based on the type of options and whether it's an incentive or non-qualified. So I will just say that if you exercise the call options and to buy the share at $50 per share, and when the current market price is about $70, $50 when you're comparing to $70, there's a $50, $70. There's a $20 difference may be subjected to the immediate taxation. So this is a very ordinary income for the non-qualified. It's a case depending situation. So if you do not exercise the options and instead you just trade or let it expire, different tax rule will apply. So if you trade the options without exercising and the profit and losses are realized, and the tax will be taxed as a capital gain. So if the option expired worthless, the premium paid for purchasing the option is considered as a capital losses. So this loss can offset the other capital gain in some certain cases, reducing the taxable income up to a very specific limit. But this taxation law will be very based on the jurisdictions and the option type and also your personal financial situations. So you might need to consult to your tax advisor before you making such decisions. And now we will look into, we have explained when to exercise. Now we'll just unpack the how. The mechanism of the exercise the trading are involving a very careful calculation and strategic timing that can make or break your trading. So move into the particles mechanic of exercise the strategy. We'll just break down the key calculations and the considerations that everyone must understand. Okay, the first one will be the break-even calculations. When you're considering exercising an options, your break-even is not just the strike price plus the premium. In the theoretical way, we are actually calculate it by using the strike price plus the premium will become our break-even point. But if you are going to exercise it, there might be some other factor that you need to consider, such as the cost of exercise, which is the principle that you need to just acquire those 100 shares, and if there's any holding costs required if you hold the stock, and there might be potential dividend income. The potential dividend income might eventually reduce the break-even pricing that you need. Let me walk you through a very real example. Suppose that you are holding a strike price of $50 and with a premium of $3, which make it, in the theoretical way, your break-even price will be 50 plus 3. So it will be 53 for your break-even point. But if you are getting paid 50 cents quarterly dividend and you are planning to hold for 2 quarters, you will make it $1, because 50 cents per quarter and you hold for half a year, then you entitled for a dividend of $1. Then you will reduce the 53 break-even point to 52. So you will just need to consider all those before you make your break-even calculation. So the other one will be the capital requirement. We already said that if you're going to exercise it, you will need the capital to just acquire 100 shares. So the capital will be way greater when you're just trading the option premium. And the third one will be the margin consideration. Regarding the margin consideration, this is often overlooked by newer trader. By exercising a call, you will need a full payment for the stock acquisitions, which same as the capital requirement, and the margin buffer for the market fluctuations, and also the account for any margin maintenance requirement. So the last one is the exercise timing optimization. The exercise timing might be crucial to trader and investor that if they are going to exercise it. So the earlier exercising usually doesn't make sense because the options still have a time value, and you are not sure if you're not sure that if this deep in the money enough or not, which means you are not certain about the probability that the price come back to pick you up. So usually the earlier exercise doesn't make sense unless there is a dividend capture opportunity. Unless there's a dividend going to pay out and you want to entitle for that dividend, so you will do an earlier exercise. But there's also the exception case where your strike price is already in a very deep in the money case scenario, and you have a very minimal time value. So in that case, I would suggest you to just exercise it and then buy at a very low price when you compare it to the current market price. So you can just ride on the rally until the end of the bull market. So this is all the risk analysis if you want to exercise your options. So even though the mechanism might seem very straightforward, but there must be a risk profile that come along. So this is the 4 risk profile that we need to look at. This will be the potential pitfall and the risk factor if we are going to the exercise approach. Okay, let me have a break. The first one is the greeds. The greeds relevant. We already talked about the time value because when we in the previous case, we comparing the dividend with the time value. So what the time value will be affecting by the greeds. The time value will be affecting by the data, the greeds data, because the data represent the time decay. And okay, we will go through one by one about how the grids relevant. The delta will become more crucial if we approaching our decision point, because the delta usually at 0.5 at the money options. So if the options is already deep in the money, the delta usually will just allocate at 1, which it will be stable at around 1. So the gamma will be affecting lesser. So you will have a lower gamma risk. So delta and also gamma we already expanded. So we will talk about data. When you are in a very deep in the money conditions, usually you only have the intrinsic value left, because the time decay actually work in a normal distribution manner, which means that it is highest, the time decay, the time value will be highest at the middle, which is at the money strike price, and it get lower at the when the strike price getting further away. So if you are in deeply in the money, or you are deeply out the money, your time value will actually be lesser. So you can just consider to just forfeit, give up the time value, and to exchange for the right to exercise it, because you can actually exercise it, and then you are aiming for a longer run, a bigger run, instead of just tiny time value left. Okay, so the second is the capital lockup periods. When we are talking about the capital lockup periods, because when you are going to exercise it, you are committing to a full stock position value, because you are going to buy it. So the cost that you pay is no longer the premium, because you are going to pay enough capital to buy 100 shares. So the risk exposure also bigger when you're comparing to just the premium losses. Initially, if you don't exercise it, the most that you can lose is just the premium. But if you exercise it, you are exchanging your options into 100 share of that particular share, of that particular asset. So the principal involved is bigger, as also the risk exposure. And there might be a opportunity cost of capital involved in this case, because if you are going to use those capital to buy 100 share, so you have less capital left. So in that case, there might be a better opportunity for the others. So you might lose the opportunity, and that will be called an opportunity cost. But if you are just going to not exercise it and then using the option as a tools, then the principal use will be at the minimum, because it's just the premium that you pay. And in that case, you have more available fund to just invest into the other stock or the other options. So in that case, the risk exposure is a minimum, and then you have more chance to just diversify your portfolio, and then the opportunity cost is also at the minimum. And then we'll just talk about assignment implications. For those traders who sell the options, the seller, the assignment will introduce an additional risk, like the timing uncertainties. Like the assignment might occur unexpectedly before the expiration, and it forces you to just buy or sell the share, and potentially just disrupted your strategy, because you have the obligation to fulfill if the buyer want to exercise. So it might distribute your strategy in your whole portfolio. And it might be a hedging losses if the assigned share move unfavorably, and then at the existing hedging strategy might be insufficient to cover the losses. So, and the last one is the portfolio impact, because when you're exercising the option, you are going to entitle for 100 share. And in that case, the risk exposure is also bigger. So the impact to your portfolio is also increasing. As simple as that. So you might need to consider about, is there any concentration risks if you're going to exercise this option? Which means if you're going to exercise this option, will this 100 share, will this capital take a lot portions to your portfolio? So of your principal, your capital will just concentrate at this particular stock. Is that worth it? So you will just need to be aware of the concentration risks and also the loss of diversifications. So this is the risk if you're going to exercise, if you're going to take the exercise approach. Now we are going to the second section, which is the second type of trading options. We are not going to exercise it, but just using the option as an individual asset to trade on, an individual trading instrument. So for the premium trading style, you are actually trading the premium as an individual stock, and then you just trade the fluctuation because there's a leverage effect on options when you're comparing to the share. So in that case, options tend to move a lot more than share because of the delta and also the gamma. We already explained it in, if I'm not mistaken, it's a lesson 4, number 4. We talk about the grids, and we will talk about how these grids will just make the gain in the option way bigger when you're comparing to the gain in trading the stock. So if you're interested, you can just check on the recording of the lesson 4, the grids. Okay, so we will not go into the detail of the grids, and we will just talk about what the core principle of this approach, which is trading the premium. Okay, which is this trading philosophy is also the most favorite philosophy when it comes to the option trading market, because usually people come for a very greater return when comparing to the share market. So usually people will just trade the options as an individual trading instrument when comparing to just exercise it and then get trapped into the positions again. So by understanding this trading premium philosophy, we will just able to understand why people are going to take this approach. So this also represent a paradigm shift in how we will just view and interact with options. This is a different way of trading the options, but it is more favorable in the market. So, okay. The first one is some people are focusing on the time value decay, because when we are talking about the time value decay, those people are usually the seller, and they are at the benefit side if the time value decay. So they tend to have a higher winning rate in the option market, so they become the seller. We already talked about why seller have a higher win rate when comparing to the buyer. We talk about it in the lesson 2, the beauty of becoming the seller in the option market. And we already talked about the underlying theory of why seller have a higher winning rate when comparing to the buyer. So the option will just lose value at a very accelerated rate. And the time decay is actually not linear. It will just typically drop in an exponential way at the last 30 to 45 days. So if you are going to just trade the option as an individual asset to trade on, I would suggest you to just exit the position, quit the position before the last month, because at the last month, the time decay will accelerate. So the time value is also reducing. So you want to make the most benefit from the buying position, you will just quit it before the last month. That is my suggestion if you are going to a safer approach. So let's look at the second one, the probability-based approach. Usually, the premium trader will focus on a higher probability trade. So for the seller, if they want to have a higher win rate, they will just become a seller. Or even though the buyer have a lower winning rate, they will also find their way to gain big instead of winning more frequently. Even though the winning rate is smaller, but they're able to just using one win to cover all the losses and make some money from it because the leverage takes place. And then they will just manage their winner earlier, because I say that the time decay will accelerate at the last month. So it's suggested to just create the option trading position before the last month. And for the seller, they might even use a strategy which is called rolling. They will just close the previous position at the losses and they just sell another position at a higher strike price to just collect the premium, and then they just when the premium collector is able to compensate the losses, so they eventually make a credit out of it. They eventually are making a profit, but they just keep on rolling and rolling. This is the strategy that they are using as a seller. They don't want to get exercise, so they will just close it and then they will just sell at a higher price if there's a short call situations. And the third one is the premium trading style is actually focusing on the short-term income generations, because they are not aiming for a very long run, so they don't really expect to hold the share for a certain amount of years. So they were just using a multiple smaller trades rather than a one big one or one big goal. So they want to make a consistent income stream, like they are just consistently selling the options in a weekly basis or monthly basis to make the premium. So yeah, so the last one is the capital efficiency, because I say that the exercise style, you actually need the capital for acquiring a 100 share. So if you are not going to exercise it, but you are going to just trade the options in and out, then you don't need such a huge capital to involve. You don't need to lock on your capital into this particular share. You can just diversify and have a better exposure to many chances. So it will be more flexible if you want to manage your position, since you don't plan to just put a big bag of money into one share. This is what they're thinking about. They can have diversify their portfolio and they can just put on every small money into different chances. And this is the premium capture strategy that they will be using. The first one is the rolling strategy. We already talked about the rolling strategy. If you are going to you're going to sell a call options, then you have the obligations to just sell it. So if you want to avoid being exercised, you will just keep on rolling. What do you mean by rolling? It's just that if the options have the risk of getting exercised, you can just close it and then you look for a higher strike price to sell on. And eventually the premium will be able to cover all the losses, and they just keep on rolling and rolling. They just keep on reducing the risk to getting exercised. This is the rolling strategy. But rolling strategy usually is just a strategy for a seller. Then the premium capture strategy is also involves the strike selection methodology. Because if you are going to trade the option as an individual financial instrument, one individual trading instrument to trade on, you actually want to just buy low and sell high, not in the stock, but in the options. So you need to consider a lot, like the delta, because the delta usually represent the winning rate of these particular options at the expiration date. So to increase your winning rate of buying into this option, you need to consider the delta. And you need to buy at a very sweet spot, not a lower price in the share, but a lower price in the options. You need to differentiate these two differences. The share price and also the premium are different. A lower price in the share price doesn't necessarily mean that a lower price in the option premium, because there's still many things that are affecting it, like the time decay and also the implied volatility fluctuations. And the last one is the expiration cycle management, which means that if you are going to just trade this one, you need to be aware of the earnings and also the news, and also you need to know either you want to trade the weekly options or monthly options, and you want to avoid all those earnings and also all the news. And this is also the risk involved when you're going to do the premium trading approach. So everything comes to a risk. So even though there's a risk along with the previous style, there is also a risk for the second style. Let's dive into the critical risk management consideration that unique for premium trading. So premium trading actually require a different risk management approach. Like, okay, let's go on one by one. The first one, the risk management. Also, so you need to monitor the delta to just ensure that the positions are aligned with your market outlook, because delta represent the winning rates. So you need to just check on the delta to identify, is this position favorable in the same direction to your judgment and analysis. And for the non-exercise stock trading, the delta actually reflecting the directional risks, and it should be managed to avoid excessive exposure. Like you are trying, I would not suggest you to buy on a option with a very low delta, because it represents a very low winning rate and it's unlikely to get into in the market at the expiration, which means you are highly just going to lose for that options. So if you are going to just trade the options, I would suggest you to just buy maybe out the money with 1 or 2 strike price difference. So it's high likely to just get into in the market in the future. So there will be higher winning rate, but you are not also going to a very low in the market options, because if you are going to choose the in the market options, it will be very expensive when comparing to other money options. So since we are going to trade this one just as an individual asset to trade on, we want to buy cheaper, we want to buy lower. So out the money might be a better choice. And we already talked about the delta. Maybe okay, we also need to be aware of the theta and also the vega, because the theta represent the time decay. So if you are a seller party, then the theta is actually favorable you. So you need to be aware of the theta. If the higher theta value will be beneficial when it comes to becoming a seller. And for the Vega actually affecting changing the option premium according to the fluctuation in the implied volatility. So if you want to just make it buy low and sell high in the option premium, you will need to be aware of the implied volatility. You need to buy when the options is in lower IV, so it will be more cheaper comparing to what it should be. And then when the volatility increase, even though the actual underlying asset doesn't move a lot, you will also be able to sell high. That is the key concept. So buying at a lower IV condition will be better if you are going to just trade the options. And okay, so now we will talk about the second one, the position limit. So we need to just implement a very strict position sizing rules to just prevent any single trade go in a opposite direction that we want. So it will be impacting our portfolio a lot. So if you are going to just trade the options as a individual asset, then you might need to limit your capital allocate to one position, because you are not going to exercise it at the end. So you are not going to turn the options into a share. So eventually it might just getting expired worthless. So at the worst case scenario, the option might go to zero. So you need to avoid putting too much into that options. It's unlike the previous type, which at the end, that option might convert into an asset. In this case, since you are trading the premium, you are not going to exercise it. So there's a chance that this option will go to expiration and it become worthless and become zero. So this is also why so many people fail in option trading, because they put too much into one or two particular options and then it go to zero. This is the risk exposure is getting too big. The option take too much in their total capital. So you need to maintain a very diversified portfolio across different strike price or even different expiration dates. And please avoid putting too much into one positions. Okay, so the next one is the margin requirement. So you need to ensure that there's a sufficient capital to meet the margin call if the underlying asset move against you. And also you need to keep excess capital in your account to just handle the market volatility and the margin increase without being forced to close the positions. So make sure that you can fulfill the margin requirement, and also you need to avoid over leverage your positions, because it will force you to be liquidations and you will just burn your whole account. The last one is the portfolio correlations. You need to diversify the trade across different sectors, different asset class, and different maybe geographic regions to just reduce the exposure to one single market even. Like if you are going to just put all the money into the tech company, even though you are putting it into different company, but they are all belong to the tech market, the technology market. So if there's a single event happen to the technology market, like if the government announce some specific rules that go against the technical market, then all the share in the technical market will just drop significantly. So you need to avoid buying too many options that belong to the same category and the same market and the same sectors. So this is what we call the portfolio correlations. You need to avoid overexpose your portfolio to one single sector. Okay. So we already talked about the exercise type, the non-exercise type, and what is the condition for both to make the most sense, to become the most optimal choices. And also we also take a look at the risk management for both. Like there's a risk for the portfolio, the exercise type, and also the risk for the non-exercise type. And now we will just come to a comparison, and then we will make our summary at the end. And then you can just take a look at the comparison analysis metrics, and then you can just decide which approach will fit you the most. Usually people will just take the second one because they want to use the very small capital to make a big money. So this is the reason they come to the option market. So usually they will just go to the second approach without a second thought. So yeah, but if you are already aware of the pros and cons for both approach, you might consider to find a better approach that fit you the most. The first one is the capital efficiency. For the exercise type, you have a higher eventual capital needed because you need to acquire 100 shares. But for the premium trading style, you will have more available capital to allocate for different different share and options. So it will be higher efficiency to use your capital. And the second, the risk profile, you have a larger directional risk for the exercise type. Because the exercise type, you already bought in 100 share, or you are going to sell 100 share. So the impact, the risk exposure is higher because it's not just limited to the premium cost, but the price fluctuation will affect the 100 share. And for the premium trading style, the risk is more manageable and it have a defined risk for the buyer, because the most that they can lose is just the premium amount, but they are not going to expose anymore comparing to the premium that they pay upfront. And also, then we will talk about the third one, the time commitment. For the time commitment, if you are going to exercise it at the end, then actually you don't need many time to just monitor the chart. And because you are actually you already target the strike price, so you just wait for the outcome and then you can just decide either you want to exercise or not. But if you are going to become the premium trading type, the second type, the premium type, so you will need more regular monitoring time, because you want to buy low, sell high in the market, so you're going to exit the market. So you are going to just monitor how the premium pricing goes. Again, for the third one, the skill requirement. So for the skill requirement, for the first one, actually you don't need much skill in the options, because if you are just going to exercise it, and then you don't need any specific strategy, the advanced strategy. A single leg strategy will be enough. Either you go to buy long, buy put or sell, buy put, sell put, buy call, sell call. That will do for your favor. Like for Warren Buffett, he only using the sell put to buy low in the share, and also the sell call to just sell high. So he only master these two so that he can make the premium, and also he can achieve a buy low, sell high in the market. And that's it. A single leg option will do. But if you are going to just trade the premium, then you might need to learn some specific strategy, more advanced strategy, like the vertical spread, the iron condor, and the straddles, and all those, to just make use of the fluctuation. So the skill required for the second type might be even greater. And the third one is the market condition suitability. I was just giving you an example, like this few months, the market is going crazily upward. So in these situations, if you are the earlier participants in the core market, then you are better to just exercise it, because it's unlikely for all those shares to just retrace back to the initial point. So if you are going to just participate in the initial stage of a bull run or a bear run, then you are better to just going to exercise it. This is my advice to you. But for now, the market is already at a very higher level. It might not be a very good suggestion for you to exercise it. So if you are going to exercise, taking the exercise approach at the initial state of one of the bull run or the bear run, then you are entitled for the whole benefit along the market, along the ride. Okay, so now we will just take a look at the market scenario analysis. We will compare, and then we will provide a very high level view. Okay, so the first one is when to use each style, the exercise type and also the non-exercise type. Okay, so the non-exercise type is actually the premium trading style. Okay, I'll just using this term, exercise and non-exercise. Okay, so exercise type, the most suitable scenario to use it is the trending market, which means I already say it, either the initial stage or the middle stage of the bull market or the bearish market. And then for the non-exercise type, a very volatile or range-bound market will be more suitable because you are not going to just target for the whole rally, and then you are just trying to make a profit out of the volatility and also the fluctuation. So for a volatile market and also a range-bound market, the non-exercise type might be better. Okay, the second one is the market volatility impact. I'll just talk about SSI type. The market volatility actually doesn't affect much on the exercise type. Why is that so? Because what the volatility affect is actually the premium, which is the cost. But I already say that the most important thing for the exercise type is actually the strike price, because eventually they want to hold the price, hold the share. So what they're targeting is actually to buy at the desirable price. So the strike price will be their main concern, and the premium cost will be less priority when comparing to the strike price. But for the non-exercise type, because they want to do a buy low sell high in the option, but not on the share, they don't want to hold the share. They will just want to get in the options and get out the options before the expiration. So it's very important for them to just pay attention on the volatility, because when there's a higher volatility, higher implied volatility rates, the premium is actually at a very high level when comparing to the price that it should place on. So if there's a volatility crash, this option might go to zero. That is the case. So if you are going to be buying a call or buying a put, you need to make sure that you buy at a very low volatility market. And then when the volatility increase, you can just benefit from the Vega effect. The Vega effect, where they talk about it at the lesson 4, the grids. So if you are unaware of what is the grids and what is the effect, why does it so, maybe you can just add me at the beginning of the classes. I will just share my contact, and then I will share you the recording of the previous list of my classes. So you can just access. I will suggest you to take on some specific class, which is the second one, the beauty of becoming a seller, which we use the option selling to achieve a buy low sell high, just like Warren Buffett did, just to replace the traditional buy low sell high in the market. So the lesson 2, the beauty of being a seller, and also lesson 4, the grids value, because this is where we will know why the grids can provide a leverage effect and what you need to pay attention to in these things, when you're picking options. And then there's also a lesson which I'm not sure about which lesson is that, but it's about the first step of making money, which is choosing the asset and options. This is the 3 classes that I suggest you to watch, because if you go through that lessons, you are able to just select the most trending stock in the market, and then you can select the most optimal options to trade. Because when you come to the market, there are so many stock, so many shares, and so many options that listing out there. So you are not sure about what is the threshold, what is the criteria to filter out the most suitable option to trade on. You need to have a filter. I will call that a filter. And then that is the step to just choosing the asset and options. So this is the 3 classes that I suggest you the most. And if you are interested and you miss out the lessons, you can just contact me at the end of the lessons. Then I will just share you the list. And then I can also just give you a priority on which one to look at. And okay, the last one is the volume and also the liquidity considerations. And for the exercise type, the volatility that you need might be just moderate. So because you are focusing on the intrinsic value. And for the non-exercise type, you might need a very high volatility, because you want to get in and get out in the market, and maybe you are having a very high frequency trading. So you need a very high volatility, high volume trading and high liquidity. So it difference for the non-exercise type. You need a higher volume and liquidity when you're comparing to the exercise type. Okay, here come the last one, I guess. Thank you for spending all those time together with me. And it has been an hours, and this will be the last thing that we were sharing for today. And after that, we can just enjoy our weekend. Okay, for the capital considerations, for the exercise type and also the non-exercise type might be different. Why is that so? Because for the exercise type, you might need a little bit bigger initial investment, because usually you are going to just buy the in the market options, so that you have entitled to buy at a lower price. So when you're buying in the market options, you will need it is more expensive when you're comparing to out the market options. So for the non-exercise type, usually we will just go for the cheaper options, which is usually out the market. So we actually will just go to the out the market options, but we are not going to just select a very far away out the market options. We are just going to select the price difference might be just one or two different price level difference when you're comparing to when you're comparing to current market price. So exercise type, you need a higher initial investment because you want to buy in the market options. Non-exercise type, you don't need that much because you are going to buy a cheaper options, which is out the market options. And then we're just talking about the second, ongoing capital needed. For the exercise type, you will need a very huge capital because you're going to acquire 100 shares. And for the non-exercise type, you don't need that much because you are not going to buy on 100 shares. So it differs. And third one, the return portfolio, the return profile. Okay, so for exercise type, the return profile is actually tied to the intrinsic value growth and the potential stock appreciation. So if there's a long run, which you already predicted it, and there's a long run, then it might be more suitable for you to capture a very high return using the exercise type. And for the non-exercise type, usually we will just get in and get out before the expiration date. So we can the trend movement that we can enjoy is actually limited at the time that until the expiration date. So you need to be aware of the returns profile. Even though the exercise type able to capture a longer trend, but the second one, the non-exercise type, actually have a greater leverage because you are trading the premium, the premium, and then the option premium actually have a higher leverage, higher fluctuations. So the return profile will be different. It depends on you want the leverage or you want a longer trend. You want to capture a longer trend return. Okay, for the last one is the risk matrix comparison. So the first one, exercise type, have a greater risk exposure because you buy on 100 shares. And then you also, the capital get locked up because you acquire 100 shares, then you have an opportunity cost, you have the greater risk exposure. But for the non-exercise type, if you are going to become a buyer only, then you only have a limited losses because all you can lose is just the premium. That's it. So here comes the key takeaway for today's lessons. For the exercise type, the most important part for the whole sessions, we only mention it for now. Let's talk about the summary for today's sessions. Okay, so for the exercise type, you actually require a higher initial capital and ongoing reserve, but it will offer you a potential for a larger and greater directional returns that tied to the intrinsic value. So it is more suitable for trader that aiming for to secure the stock ownership or hedging. The key word is you need a higher cost, but it offers you a greater directional return. That's it. Higher cost, but you're able to enjoy a longer trend movement. For the non-exercise type, actually you are focusing on a lower capital outlay, and then you will benefit from the premium fluctuations. So it offers a smaller but consistent return, especially for the seller that leverage the time decay, and it will be ideal for a shorter term strategy. Okay, so in short, the keyword, non-exercise type, you don't need that much capital. You need the minimum capital to just trade the options. And then even though you are not entitled for a longer trend movement, but you'll have the diversifications opportunity. And also, if you become the seller, you can benefit from the time decay. And if you become a seller, there might be a very consistent return for you because there's a very high win rate. And that's it. We will just end our lesson for today. Thank you for all of you. And this will be my personal contact in WeCom. So if there's any question from you, you can just contact me. And if you want to just access to the previous recording, you can just access me and ask from me. I can speak in Chinese and also in Cantonese, either way you do. So this is my WeCom. If you feel free to contact me. So if there's any topic that you want to discuss, feel free to raise it and then we will just arrange it accordingly. And then at the end of our sessions, I'll just introduce you the benefit of opening a Usmart account right now. So if you are going to open a Usmart account right now, you will just going to get 0.02 shares of Tesla. And if you deposit more money, then you are entitled for more cash voucher. And this will be the registrations QR if you are interested to start on your trading journey and also your investment journey. So the above one is the Singapore app for your registrations. And then the above one is also the global apps. But if you are a Hong Kong user, you can use the below QR for your registrations. So if there's any question, you can feel free to raise, else we will just end our session today. We are ready. It's already an hours, just like we expected and planning for at the beginning of the lessons. If there's no question from all of you, then we will just end for today's sessions and hope you guys can enjoy your weekend and hope you guys can make money in the market and hope to see you guys again in the next classes. And at the end of the session, I'll just share a little bit of a disclaimer just to avoid any unnecessary issues. Okay, thank you guys for joining, and then we will just going to end our session right away. Thank you.